You've reported results just ahead of the revised consensus, but what's your view of this year's performance?
Well, as expected, 2014 was a difficult year. We embarked on the year with a clear plan to transform our group by focusing, simplifying and ultimately growing our business again. That is unfortunately not yet reflected in our numbers, but there is a lot of positives which we take into 2015 out of 2014. And that is, obviously, we had a successful World Cup. We engaged with our customers again successfully. We built mobile capabilities from a product perspective, but also from a marketing perspective. And obviously that is reflected in our numbers already by growing our mobile revenues by 100% year over year. We also started to see what a huge asset we have in-house in the forms of studios, and I will explain later what that really means. And we started to commercialize that business opportunity for that group. And all of that by reducing our fixed cost base substantially. Last but not least, we also packaged up our non-core assets and we started to sell several of them already, and others are in the sales process. So in total, and in summing up, 2014 was a year of challenges, but we really built a sound basis for future success in 2015.
You announced the shift to what you call a label-led structure at the time of the half-yearly results. Now that it's been in place for a while, can you explain what benefits you're seeing and what it does to add clarity of understanding for the shareholders and the staff?
Well, overall what it gives us is a much more simple operating structure. It increases the speed of decision making. Each business unit owner has more freedom to maneuver now, and he has the ability to make decisions on the spot. All of that resulted out of a discussion where we made clear what is expected from each business unit owner and what can he expect from the corporate centers. So this whole process was streamlined. We entered into clearly defined service level agreements, and all of that happened at a reduced cost. So it enabled us to take out several management layers. Again, decision times are much faster right now, and gives each business unit owner more autonomy to create value for our shareholders.
So mobile grew strongly across the businesses. Have you got this cracked now, and can we expect this growth to continue?
My firm answer is yes, and my belief is yes too. And obviously we have doubled our mobile revenue in 2014. And that really has three elements, the success of our mobile development. First is we have developed our sports offer in-house, completely in-house. We have also integrated third-party products on the game side, which helped us widen our offer for our consumers. And lastly, but most importantly, we have built mobile CRM capabilities which we just did not have before. We all know that mobile is most likely the area where whoever wants to be successful in our industry has to succeed. And we have again started out very well in 2014, and this will now move into 2015 as we speak.
Can you explain your new strategic framework? Specifically, what do you mean by seeking a long-term strategic partner for the B2B business driven by the sports business?
Well, whilst we are transforming into this new organizational structure, one of the newly created business units is our product and technology arm. Internally, we call it Studios for the time being. And we believe that actually the Studios part of our business is going to be one of the greatest assets available to us. And always bear in mind, the last 3 or 4 years, we had to integrate our platforms and our front-end technologies and migrated customers. But now that this comes to an end, and eventually now in March of this year, at the end of March, we will do the last integration, which is Italy. We will be done with it and we will free up a lot of resources. At the same time, Studios has serviced all of our B2C labels in multiple 11 licensed regimes, multiple products, multiple front ends. So we virtually had a B2B company already in-house. But it's a huge difference whether you run it as a cost center or as a department, or you run it as a fully responsible P&L and with a clearly defined business owner. Now, as we are now commercializing our Studios and our business unit there, we have started to put a small sales team together. We have appointed the best internal people we had available to us, and we also asked for some outside help, so we got some experts involved. And when we tested this approach and that product actually with customer demands, we were surprised what we found in the market. There's substantial demand for a sports-led B2B company, and this is exactly what we're going to do right now. So we're going to enter into negotiations with large customers and selling them our solutions, which we have bespoke developed in the past for our B2C companies. So I'm very excited about that opportunity going forward, and we will see the benefits coming through starting in 2015 and most likely in 2016. We should actually run a profitable business on that P&L basis.
Earlier you talked about a shift in approach that is opening up a raft of new opportunities. Could you be more explicit about that?
What I meant really is the area of CRM. And that was an area which we clearly saw a year ago and identified clearly a year ago as a weakness. And we have addressed it aggressively since then. What we have done is we have cleared up all redundant systems we have deployed, and we integrated new tools and new infrastructure into our platform. At the same time, we have created the ability to utilize CRM methods also on mobile, which was actually something we could not even do technically before. And now we are in a position to target our customers much more directly with actually relevant content, and we are dynamically generating that content every day now and dispatching it automatically to a large set of micro customer segments. So what we did before very generically, we are doing very, very targeted right now. Now the benefits, we only started this initiative a few weeks ago. We have seen the results already coming through, but at the next year's half-year results, I will actually come back to you and give you more data to substantiate the progress we made.
In the second half, you're hoping to launch into new territories. How significant are these opportunities, and which products will you launch in each market?
Well, first you have to look back the last few years, and the last market entry into a nationally regulated market was the US. Now everybody is aware that we actually entered the US successfully. Unfortunately, the market size was not as large as we expected it to be. But other than that, over the last years, we actually closed down markets. We had to get out of certain markets. So 2015 is a year where we actually strive to re-enter new markets. Now, it will all depend on how regulations shape up. Will we get licensing access or not? But we are confident that we will at least enter 2 new markets in the second half of 2015. And we should be able to actually generate up to about 10% of our total revenues from those 2 new markets.
Now, Germany remains an uncertain market regarding regulation and is your largest single national market. If it should go belly up, what confidence can you give shareholders about how and how quickly you can respond to any resulting lack of revenues if you have to withdraw?
Well, I don't know, I can't even count how many years people or investors or whoever out there has expected us to belly up in Germany. May I remind you, we are operating in this country now for 16 years, since 1999. We are a leader in Germany, and we have a clear plan for Germany. As you know, there's actually 2 ranges of products. On the one hand is sports betting, and there's a clear road to regulate sports betting in Germany. We have received an indication, obviously, that we will get one of the 20 licenses which were supposed to be issued in Germany. But unfortunately, this whole process is tied up in courts because the ones who did not get a license are obviously trying to get in. So currently on the sports side, we are paying tax there. The industry pays about 200 million euros of sports betting tax in Germany already. And we would expect to continue operating in Germany under the current framework at least for another year, if not more. On the other side, or the other product range, you have games, which is actually poker and casino. And we have started to engage with commercially sensible, relevant authorities in Germany to also find a solution for those products. Because at the end of the day, the alternative is a ban on those products, and what that would do is drive games and as a casino and poker business into the underground. So that means no regulation, no tax, and no consumer protection. So we are quite confident that at some point the relevant authorities in Germany will acknowledge that regulation is much more advantageous than an outright ban. And on the other hand, one thing is also quite amazing, that currently many see Germany as our biggest problem. I actually think that Germany is one of our biggest opportunities, because once the market is nationally regulated, everybody will try to come in, and then they will have to face us as one operator who is established in Germany and whose brand is second to none.
How would you characterise these results?
So I would say that the results were mixed. Clearly we would like to have grown clean EBITDA, but clean EBITDA fell by 7 million euros. I think you need to look at the context of that. We had headwinds in the form of the closure of Greece and some ISP blocking in other markets. That had an adverse impact at clean EBITDA level of 17 million euros. And then of course we had a first full year of operating in New Jersey, and the incremental impact at clean EBITDA was an additional 5 million euros loss in 2014 compared to 2013. That having been said, there were a lot of positives in the results. We doubled our mobile revenue. We increased the proportion of revenue coming from regulated and tax markets from 53 to 56%. And we managed to exceed the cost-saving target that we gave at the beginning of the year and subsequently revised during the year.
So you say you've exceeded your target, but by how much?
We initially had a cost-saving target of 20 million euros. We revised that during the year to 30 million euros, and we actually delivered 34.4 million euros, and that's without adjusting for the fact that we acquired PXP Solutions midway through the year.
Despite the FIFA World Cup in 2014 and the increase in mobile, sports betting is pretty much flat at the revenue level and saw a decline in clean EBITDA. What's behind this? And is this a systemic decline or is it reversible?
Well, we had issues with the closure of certain markets throughout 2014. I mentioned Greece earlier, and we also had some ISP blocking in other markets. Specifically for the sports vertical, that had an adverse impact of 14 million euros. As we go into 2015, we're actually looking to go into certain markets that we have either been in before and have had to withdraw from, or we haven't been in.
Okay, so despite the growth in both their revenues, only poker and bingo achieved growth at the clean EBITDA level. How was this achieved, and shouldn't you be applying the same approach more widely across the other businesses, which have seen decreases in clean EBITDA?
So both of those particular business units benefited from the overall cost reduction program that we put in place through 2014. Clearly with poker, we're looking at the reduced scale of the opportunity. This is something that is not just impacting ourselves, it's impacting a number of other operators in the sector. And so consequently, we've scaled back investment in that area to reflect the reduced scale of the opportunity there. In respect of bingo, we have become more efficient in our marketing activity, but bingo, like poker, also benefits from the overall cost reduction program that we put in place, because obviously it then gets a reduced allocation of certain central costs. We will look to continue to take out costs wherever we can going forward, and we've got a 15 million euro target for further cost savings in 2015.
Delving into the minutiae of the release, your reported losses for the US on page 11 of 9.8 million euros, but in your new segmental reporting table on page 9, the loss shows as 6.1 million euros. Why is this?
The first figure you gave, the 9.8 million euros, is effectively the cost of the US operation, taking into account all of the costs of operating the platform in that particular marketplace. When we move to the new segmental reporting basis, what we've done is to effectively treat each of the labels, whether it be the bwin labels, the games labels, or the US business, effectively as gaming operators that are buying in services from bwin studios at an arm's length rate. So what that effectively means is that if you're operating with insufficient scale in a particular market, which is the case with the US, as we know, New Jersey wasn't as big as everyone thought, then effectively those losses are now picked up within the studio segment as opposed to the US. So it's just a different way really of looking at the businesses, and it will make the results more comparable to our peers who are typically buying in a lot more third-party services than we are.
Okay, so overall, cost of sales has increased, driven by a more than doubling of other unspecified costs. What are these?
Well, the largest part of cost of sales is, of course, gaming duties, and that was flat year on year, and broadcasting costs were also broadly flat year on year that relate to the World Poker Tour. The component that you're referring to is effectively commissions paid. They arise in some of our non-core businesses, such as Intertrader, the financial spread betting business, Winners, our Spanish retail business, and also the social gaming unit, Win. Intertrader launched its own licensed service, Intertrader Direct, last year, which has grown rapidly. It's been very successful, and as a result, the commissions payable to third-party introducers has increased. It's also worth noting that Win, the social gaming business, also grew revenues significantly year on year and had a similar increase in commissions paid.
You're now facing a UK point of consumption tax and European VAT, plus many other country taxes. With all of these and the competitive pressures, is it really possible to make reasonable profits in regulated markets?
Yes, it is. And of course, I mean, we are making reasonable profits in regulated markets at the end of the day. The level of margin, and in a particular market, does depend on a number of factors, of course. It's not just the obvious one of what the tax rate is in that particular market, but it also depends on, have we got a full product offering that we're allowed to offer the consumer? Are they enforcing against black market operators so that effectively everyone is, operating with a level playing field? And, how many bespoke requirements are there for the operating platform, because obviously that feeds through into additional operating costs.
Now, staff numbers and costs are down, as are directors' emoluments, but with the same number of directors. Have the directors taken pay cuts, or are the new directors cheaper?
Well, staff costs were always going to be a significant part of the overall €30 million cost-saving target that we put in place. And indeed, if you look at the workforce costs and overhead, it was around €20 million of the 30 million plus saving that we made. In respect of your specific question about the directors, it's actually a combination of factors. In some cases, directors who left the board were replaced by the incoming directors at lower fees. And also there was a change in the rates payable to the existing directors as well.
You announced that you're selling Win, the social gaming business. Isn't this just an overall loss given your investment in it to date?
So we have announced that we're looking to sell that business. We're looking to sell it because we're focusing on the core real money gaming activities going forward. But a few points I think are worth bringing out. First of all, the business has actually been profitable from the beginning of this year. And when we talk about selling Win, we're not actually selling the whole of the business. If you recall, when we went into social gaming, we had an operation based in Israel, we had an operation based in the Ukraine that we acquired midway through 2012, which was a large development studio. And the operation in the Ukraine is staying within the group, and those resources have already been redeployed to other projects on the real money gaming side. And the other thing that's worth noting is that we're retaining all of the rights to use the slots that we developed for social gaming on our real money gaming casinos. So that will also be another benefit that we would have had from the investment in social gaming.
Now, World Poker Tour appears to be expanding successfully, deals in Asia and other territories. What are your plans for the business?
Well, the World Poker Tour does seem to be going from strength to strength. The WPT 500 at the Araya in Las Vegas was very successful. We hope to have a repetition of that success on an even bigger scale in the current year. We've also seen successful tournaments taking place at Dusk Till Dawn here in the UK. You would have seen recently that we signed a new long-term partnership with our game in Asia. So we're very excited about the prospects of World Poker Tour. Going forward, we may be looking at further strategic partnerships in order to ensure the continued success of that particular business.
How do you see the opportunity afforded by Calixa's joint venture with Millicom?
Okay, so the joint venture is called Circulo, and it's basically been established to target the opportunity that we see in the high growth markets of Latin America and Africa. In 2015, we're looking at launching in Brazil and Colombia, and thereafter in 2016 into another 6 Latin American markets. And obviously we're looking to leverage the distribution infrastructure of Millicom in that region. I would say, whilst it's a significant strategic opportunity for Calixa in the medium term, for the group as a whole, it's unlikely to contribute in a meaningful way to revenues in 2015.
Does this year's very large, albeit non-cash impairment charge really reflect a lack of confidence in the business, despite the increased dividend?
No, not at all. I think at the end of the day, it reflects a recognition of the reduced opportunity in poker and the challenges that we and others in the industry face there. And also our decision to refocus on our core real money gaming business and divest the social gaming assets. The charge was basically made at the half year. There hasn't really been any material change to it throughout the year, and it certainly doesn't reflect any loss of confidence in the business. In fact, we're very excited about the prospects of the business, given the transition to the new label-led structure and the opportunities that we see in mobile going forward.
So how does the current trading make you feel about the year ahead?
Well, current trading, if you look at the revenue year on year, we're actually down. But again, if you get behind it, then you'll see that sports and casino were actually down because of margin. They were actually both up if you look at the bet volume. I mean, sports volumes were up 9%, casino was up 6%. In respect of poker, it was down year on year, kind of in line with last year. No real surprises there, and we've guided the market to expect a similar decline this year. And then bingo is trading up compared to last year. So it's broadly in line with expectations.
You say that you're still in talks with a number of parties. I appreciate that these are confidential, but can you give us some kind of indication of the sort of consolidation approach that you think would give best value to shareholders?
Well, as you recognise, it's difficult for us to comment very fulsome manner on this. We've said what we're going to say in the press release. Back in the autumn, we said we would explore industry consolidation because we think that there are circumstances that could create value for us and for others. That process is ongoing. As we've said in the release, we are in discussions with a number of parties and we have received some proposals. Our job as the board is to evaluate those and compare them to business as usual, and I hope you'll see from today's results that we have a very strong agenda that does not rely on consolidation.
The market thinks that any major deal is now unlikely this year, especially before the UK elections. Do you agree with that?
I don't think the UK elections have a lot to do with these long-term changes in industry dynamics, point one. And point two is the UK is not a large proportion of our business. So I don't think what happens in the UK will actually fundamentally affect our outlook or changes the long-term drivers of the industry.
All other things being equal, and if there is no consolidation this year, do you think it's possible to achieve a return to growth across the business in 2015?
We're certainly targeting growth in a number of areas. We're showing in the presentation the areas of renewed focus. We're talking about accelerating our transformation program. We've got some headwinds in terms of taxes and other things, but we're absolutely determined to remain in control of our agenda and do what we can with the business under a business as usual case. And then if consolidation is the right thing to do, that's an added benefit on top.
You announced last April that you were recruiting 3 new directors because 3 were retiring. It's taken until now to appoint 2. What should shareholders read into that?
Well, I think it's very simple. One of the 3 retired straight after the AGM, and the other 2 were scheduled to retire this May. And each of them chairs an important committee. And so we thought that we would take time to find the right people. They're not needed until this May. And we thought this was the right time to bring them in with a short glide path so that they can take over from their predecessors in May. On the third position, which is what we call our technology director, we are making excellent progress, in fact. We're very hopeful of being able to make an announcement in the second quarter as to who that person would be. So I think come the AGM, it will be very clear to people the quality and type of people we're bringing into the board.